Stephanie, one of the big surprises of 2017 has been the scale of the economic growth in Europe. How do you see that panning out as we move into 2018?
I think it's still well underpinned. The real driver of GDP in Europe has been domestic demand. And I struggle really to see how that gets challenged near term. We've got unemployment coming down, which is obviously a key driver, accommodative policy, and generally a lot of economies well below previous peak. So I do think we can continue to see quite a robust growth rate in Europe.
You mentioned monetary policy there, and clearly for a few years we've had low interest rates and quantitative easing. Is that beginning to change now?
I think it's more a case of the ECB sort of maybe taking the foot off the accelerator rather than really slamming on the brakes. I think they've made it very clear that they want to be gradual in the process and obviously don't want to inhibit the growth in Europe. So again, I think that's quite a supportive element for European GDP into next year.
Of course, the downside of low interest rates is that it's difficult to generate an income. As an income manager yourself, how are you finding the region as a source of yield?
I think it's interesting. I mean, it's getting quite tough to find yield in bond markets, and that's clear. But in equity markets, particularly the European equity market, actually there's really quite a lot of yield still on offer. It's one of the few regions that you can actually get premium yield to 30-year averages. And that's across a number of sectors. A lot of the companies have got strong balance sheets, payout ratios don't look extended. So again, I think that's quite well underpinned, and we're not struggling to find yield at all.
And politics was important in 2017 as well. We started the year quite concerned, and then people seemed to relax in the middle. How do you see that evolving as we move into 2018?
Politics makes very good headlines, and there's a lot written about it. But I think what's interesting is when you look in reality as to how it actually impacts markets, we've seen precious little impact at all, either in the bond markets, whether it be sort of peripheral spreads or whatever, or in the equity markets themselves. So again, I would assume that would be the case moving forward as well.